Hey guys, welcome back to another episode for Ask a CPA. My name is Brett Phillips. I am a CPA here in Dallas, Texas, and I am here with Russell Wallace, the one and only CPA up in Denton, Texas, which is right outside of Dallas. How you doing, Russell?
Doing great, Brett. How are you doing this wonderful hump day here, right?
Yeah, man, it's Wednesday. It's been a good week. I've just been slammed with meetings all week. But it's good. It's good problem. A lot of new client meetings, which is kind of unusual for right after the tax deadline. But yeah, it's been good, man. How about you?
Yeah, good week so far. It had a little vacation post tax deadline, so that's why we've been a little bit silent here on the podcast. But I'm
Nice. Yeah,
happy that
tell us
we've
about
got
it. Where'd you go?
took the kids to Disney World. The quintessential American pilgrimage.
Yeah, how was that? Did you
It
have
was a
any
lot of
money left
fun.
over?
No money at all, man. No money at all. Man, they just, it's one of those things where you feel like, you're paying a good amount, you're staying in a nice place, a nice resort, you're going to Disney World, you're buying these tickets, and when you get there, you learn about all the different ways you can kind of level up your vacation, and you also realize just like how many levels there are to wealth and how you're not there yet, you know. Uh,
I don't know, man. I think you're up there.
well, I'm no VIP. I learned about the VIP access where it's like 10 grand a day for 10 people, you behind the scenes, all of this, walking around, meeting the characters, employee tunnels up to the rides. You never have to wait in line, all of
Wow,
that stuff. So
that's crazy though.
that's
Those
nuts.
kids, those kids are gonna suck as adults, right?
Yeah, that's per day, right? So if you go to all the
Per
parks,
day.
multiple days, I mean, this is 10 grand per day on top of all your park tickets and all of that. But
Yeah.
they do throw in snacks. I did learn you get
Okay.
free snacks.
I
So
can eat
that's
a lot
good.
of snacks. I mean, I can make it
Yeah.
worthwhile.
Yeah. Yeah. Well, it's different than when we were kids, right? I don't know if you went when we were kids, but like they got these like Star Wars themed stuff, so it's not just like Mickey Mouse anymore.
Yeah.
So it's pretty cool. It's
I
pretty
remember
cool.
those Mickey Mouse ice creams that had like the two, the Mickey Mouse face. Those things
Oh
were
yeah,
awesome. They still
yeah.
have
They're like
those?
$25. Yeah,
What a
yeah,
rip. Yeah, we
yeah.
went a few years ago and we did like breakfast with Mickey, and it was like a buffet breakfast. It was a good buffet. I mean, they had like waffles and
Sure.
they
Yeah.
went all out, but it was like I think it was like 150 bucks. I mean, no, maybe not that. Maybe it was like 70 or 80 bucks a person. So like these kids who ate like, one bite of eggs and half a waffle, it was like 80 bucks. You're like,
Oh my
oh,
gosh.
for like
Yeah.
2 seconds of like, hey, Mickey,
Yeah.
it's
It does something to you. Like you get kind of, I call it kind of dad mode, where like as soon as your kids like complain about anything, you're like, you will not complain, you will
you will
be,
enjoy this.
yeah, this is the happiest place on earth and you will be happy.
It's fun though. We also did like a dinner at the Princess Castle, and that was really cool. Like, um, I'm sure they were serving wine or something, so I was like over, paying $80 a person for dinners or meals, and they had like these desserts that the kids like painted on, then they could eat them. That was pretty cool. I
Yeah.
remember that being pretty neat, but.
Yeah. Well, my kids built what is like R2D2 robots, droids or whatever. They had
Okay,
this
cool.
workshop. They built these droids, and just again, it's like three droids, and then they have the add-ons. It's like $500 or something, for these three. And my youngest, who's 9, I mean, we were home. We got home, which I guess is a small victory, but we were home like 2 days, and like the leg broke off or something. You're like, oh my god.
Yeah.
This is so dumb. This is so dumb.
Yeah.
But, so we did the whole Universal Studios thing too, which is kind of cool. A lot of
Yeah.
my kids are older. They're riding roller coasters, so this
That's
was a
fun.
good shot, to a good chance to ride roller coasters with them the first time. They have the pictures, right? So you go down the big drop and they've got the picture and you get to go after the ride, kind of look at everybody's picture. And the
Oh,
first
that's fun.
couple, the kids are just like, they're balled up, they're almost crying, like they're totally scared. And then, by the time we've ridden, 4, 5, 6, 7 of these things, now they've got their hands in the air and they're smiling. And so you get to see like this progression, of
Yeah,
their roller coaster rides, and that was cool.
that's neat. Yeah, we're doing Universal this summer. It's my parents' 50th wedding anniversary. So
50
they're,
years, that's awesome.
yeah, they're taking us and all the grandkids. I think they have like, I don't know, 15 grandkids or something. So everybody's going.
Wow. It'd take
Yeah,
you 50 years to save up for that vacation. There's no doubt.
I know. Yeah, we're staying at like the Hard Rock. It's gonna be cool. I'm
Oh,
excited.
that is awesome. That is
Yeah,
cool.
yeah. I think the kids will just want to play in the pool, but
It's just- you have all these tickets to the parks and stuff, and they're like, "Can we just go swimming?"
right, right. Yeah, it'll be fun. I'm excited.
Yeah.
Well, cool, man. Well, there's some pretty big news going on right now, right? There's some
Yeah.
proposed tax legislation. Yeah, so let's jump into that in this episode and kind of go through some of the proposals, if we think they're good or bad, or yeah, kind of what you think about them. Have you reviewed everything, and or kind of what's your initial thoughts on the current House proposal for the tax reform for this year?
Yeah. So when I read these things, it's always kind of in the vein of like how it affects my clients, right? Am I giving good news and I'm excited about it, or am I having to deliver a bunch of bad news over and over again, right? But and I would say this new kind of proposal is it's good and bad, right? So it depends on where you're at and where your income is at, that sort of thing, or and really even what your job is, right? So there's some really nice, neat things that they've included, that maybe some things that were left out in the prior tax bill in 2018. So things like, doctors, lawyers, accountants. We have a lower QBI deduction than other industries, and sometimes even not at all, depending on your income. And so a lot of that was changed, at least in this preliminary bill. And I think that that's the thing that we need to kind of reiterate over and over again here, Brett, is that this is all preliminary, and
Nothing's passed.
yeah. Love it or hate it, that this administration, is going to bring about some change, right? We're gonna have lots of changes before this is a final bill. There's no doubt
Yeah,
about
exactly. Yeah, it's and I think it's good, man. There's a lot of things that I really liked about it. So first of all, they're calling it the Big Beautiful Bill. What'd you think? What'd you think about the name?
that. Triple B, the triple B. It sounds like a ranch down here in Texas. We've got the 4 6s and some different things, right? So like the Triple B Ranch. That's kind of what I think of when I first heard that.
Yeah, well, it's actually the one big beautiful bill. That's it's such a Trump thing.
So much a Trump thing.
It's so funny. But let's just hit some of the highlights real quick for people that aren't familiar or don't study tax code like we do. Um,
You mean
so
people don't wake up and spend
in
the first hour of their day on the Wall Street Journal and tax Twitter?
yeah,
Like this isn't
reading
this isn't
reading
everybody.
proposed tax legislation. Yeah. Um, so most of the Tax Cuts and Jobs Act are 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 set to expire at the end of this year. So this bill
Mm-hmm.
is going to extend a lot of those or make them permanent. So they increase the standard deduction. So most people don't itemize anymore; they just take the standard deduction. And they've put a couple of limitations within the itemized deductions. So currently, the itemized deductions includes um, your medical expenses that exceed 7.5% of your AGI. So most people don't have medical expenses that are
No, it's a
that
bad
high.
year if you do. It's a bad year.
Right. And then mortgage interest that on the first $750,000 of debt. And then there's SALT, so your state and local taxes, and your property taxes are included in that SALT deduction, which is currently capped at $10,000, which hurts a lot of people, especially in the blue states that they have a high
Mm-hmm.
state income tax. So think like California, New York, New Jersey, Connecticut. These states have 10, 12. 13% state income tax, even like Hawaii and Oregon. Some of these states have really high state income taxes. So high income earners in those states, you may pay $50,000 in state income tax, and you're only allowed to deduct $10,000. So it really hit these blue
Yeah.
states hard. And that was obviously intentional, as part of the original Tax Cuts and Jobs
Mm-hmm.
Act. Um, so, um, so what else? What else did I said? There's real estate taxes, and then mortgage interest, and then charitable contributions and medical expenses. Charitable contributions, there's not really a cap on that. It's 50% of your AGI, which most people would never hit. So for most people, it's going to be your mortgage interest, your property taxes, and your charitable contributions. You may have medical expenses, but probably not. And there's limitations on both your mortgage interest and your property taxes. $750,000 of debt, which in nowadays, that was a lot 5 years ago, but today, with the property values increasing so much, a lot of entry level houses are now, $400,000-$500,000, and so it's not
Mm-hmm.
unreasonable to pay $1 million for a house these days. Um, so with these changes, some of the highlights, that the proposed legislation is to first increase the SALT deduction up to $30,000 of state taxes. That includes property taxes if you're in a state like Texas, like we are, where we don't have a state income tax, but our property taxes are higher, so we're allowed to deduct that. Um, so state and local taxes, $30,000 proposed rate. So that would be great. What else are some of the highlights on this? So most of the current tax provisions will be made permanent. The SALT deduction goes up to 30,000. It puts a cap on your total itemized deductions. Do you see that? It's like, what is it, 25%? Let me see real quick.
No, I didn't see that at all.
35%
Yeah.
of your total itemized deductions can't exceed 35% of your total income. So yeah, a cap on that is kind of crazy. Again, these are proposed. This is going to eliminate all of the green tax credits, so the home energy tax credits, the green auto, the $7,500 for an electric car. Those are all going to be eliminated. It is going to make tip income tax deductible, so you still have to report the income, but then you get a deduction. So
Qualified tip income,
right?
right? So
It
we
would
don't really
be
know what qualified means yet.
right.
So, uh,
And overtime as well. So overtime would not be taxable as well, which would be great. I'm sure everybody's thinking, well, I'm just going to move everyone from salary to hourly, and
yeah,
then their overtime, they won't have to pay income tax on their overtime,
yeah.
which
Every public accountant is begging to be salary. I mean, begging to be hourly
right.
if
I
that
know.
goes through.
I
There's
was
no
reviewing
doubt.
this with my team, and everyone's like, "Can we just move to hourly and you can pay us overtime?" Like that would be
Yeah,
fine.
yeah. And
So we'll
depending on what
see.
qualified means, right? Like,
It,
half your bill is going to
yeah,
be a tip.
exactly. So they definitely put some limitations on this, I'm sure. It does make the Section 199A, which is the QBI deduction, makes that permanent. And the biggest, well, there's two major things that everyone's been looking for. So one is it restores 100% bonus depreciation,
Oh
retroactive to
yeah.
2025, through 2029. So that would be pretty amazing. It gives us 4 years of 100% bonus depreciation. So we do a ton of real estate. So people are doing cost eggs, or
Mm-hmm.
businesses that are buying up a lot of equipment. It makes anything that's short life assets, eligible for 100% bonus depreciation, which would be great. What do you think about that? Do you have a lot of clients that have been like eagerly anticipating that?
Oh yeah, yeah. I mean, it's all of my tax planning styled meetings, they ask me what's going to happen with bonus depreciation, right? And it's like the number one thing on their minds. They're eyeing that brand new Range Rover,
Yeah.
and they're waiting on to pull the trigger or not. So I guess now they're definitely going the all gas Range Rover and not the all electric. That's for sure.
Right.
But that's what they're eyeing. So I would say that, like what I was mentioning earlier, you're going to have some winners and losers, right? And anytime you have a big change, you're going to have some winners and losers. So some of the losers here are going to be people who have in the past used S corps and partnerships and paid. So federal purposes, just a little kind of a little back brief here. Federal purposes, you have a business taxed as a partnership or an S corp. That income flows through to your personal return. You get taxed. It just adds to your income, and you pay your personal tax rate. And that's why you have the QBI deduction, because it goes against some of that business income and all of that. And that's why that QBI deduction is so important. But if sometimes you can elect, especially if you have a lot of partners, a lot of out-of-state investors, so they don't have to like file a Pennsylvania return because they have one real estate investment in Pennsylvania, that sort of thing. The entity will elect to pay that tax, and that's a tax deduction for that entity. But that's also now capped. It didn't used to be capped, and so that's also now capped. So a lot of high-income earners, essentially just converted over, even though it's a slightly higher tax rate for high income earners to pay that pass through entity tax at that business level. They elected to do it because it was a tax deduction for federal purposes. So now that's going to be capped, and so it's going to be just make it on. You just bring it into parity with if you paid it at the individual level versus the entity level, right? So it's just bringing parity to it, but it still creates a cap. And it's a lot of my clients, part of a planning thing was to say, hey, due to the Tax Cuts and Jobs Act, we're going to now elect to pay this tax at the entity level and not at the individual level. And so that's going to kind of flip that on its head. The other losers are going to be charitable organizations, right? So charitable organizations, when they first passed that Tax Cuts and Jobs Act early on, got really hit. I have some friends that work in nonprofits and just decimated their contributions, especially initially, as people just realized, hey, there's no tax deduction for this anymore, right? There's not a bunch of CPAs out there saying, hey, go donate to charity because it's a tax deduction. And so it removed a lot of that incentive, and this is going to do that more because of that cap on income. And where it's really going to hurt is that we would use DAFs, so donor advised funds, which allow you in a high income year, you have this peak of income, let's donate a whole bunch of that money to charity, and then you get to distribute that money over time, right? Well, now we have that limit, it's going to be problematic, especially if that limit doesn't carry forward in like a credit, so you can just use it against future years. If it's just eliminated, then that's going to eliminate that whole tax planning piece altogether. And this is something that people would use if they're selling a business or they're selling a bunch of real estate, that sort of thing. They're generally putting millions of dollars into these donor advised funds and then giving it away to charity over time. So it's a really big thing for the community. It's a great thing for the community, but they're just not going to do that anymore if they don't get that tax benefit. So there's a couple of losers already, kind of from this bill, but there's also going to be a lot of winners with 100% depreciation. A big win here is that doesn't phase out over time, so it makes it a lot easier to think about, strategize, and plan for the future, which businesses love consistency, right? And so if you can plan, if you can say, hey, like I'm gonna have this cash outlay over the next couple of years, I'm gonna have a tax outlay as part of that because I can kind of plan about what bonus depreciation is going to be. I don't have to like hurry up and buy a piece of equipment, by December 31st, or I'm going to lose a big bonus depreciation tax attribute, right? So I think that's great. Making the QBI permanent, making the SALT deduction permanent. Some of these things that I'm just making permanent is great because then we don't have to have this conversation every 3 or 4 years, right? When we have a new administration, a new Congress, like what are they going to do? I don't know. Like these things are going to sunset, and now we go get to have these government shutdowns and all of this other nonsense that happens, right? We can just avoid all of that.
It is interesting that they're restoring 100% bonus depreciation just during his 4-year term. As soon as he's out of office, so people will try to accelerate and buy more, stimulate the economy while he's in office, which will drive up growth and,
Yeah.
expenditures, which obviously would help, you know, when
But
they're,
it's also a good campaign ad for the next
yeah,
administration, right? Like, oh,
exactly.
what are you going to do about, you know what I mean? And all of
Right.
that. So it's, there's
Right.
no doubt that they're,
It's
the political
intentional.
strategists are strategizing,
Yeah.
that's what they're doing. There's no doubt
Yeah.
about that.
So that's kind of the first big announcement, is that 100% bonus depreciation would be restored under this proposed legislation. And the second one is that they're going to increase the estate tax to $15 million. So currently, the estate tax is set to sunset at the end of this year, and so they're gonna increase the estate tax to $15 million beginning in 2026.
So if you're
Um,
planning to die at the end of this year, you don't have to worry about it. You're safe. You can plan to die another year.
yeah,
So
exactly.
It
Yeah,
is like a morbid conversation when you have these conversations with people, especially heirs, right? About,
right.
estate tax planning. And you're like,
Yeah,
well, if your parents happen to die, before 2026 now, then I'm not saying that you want them to die, but if they happen to die, then you're going to inherit a lot more money.
right,
Uh,
right.
but that is the conversation we get to have every once in a while.
Yeah, so it was set to, or it still is set to, decrease to about $5 or $6 million. It's adjusted for inflation and different things. But yeah, if it's extended to 15, that would be great. A lot of people are still looking. There's still benefits of setting up, a living trust and maybe a generation skipping trust and some other items. So we still recommend that our clients work with a good estate attorney and
That's
make sure
right.
that there's still reasons to do these things, and to still, at least have a will in place, and probably a living trust if you're getting older and have a complex estate, or if you're a blended family and you have children with a prior marriage and maybe a new marriage. You really want to make sure you have a living trust in place and have everything nailed down as to where the funds are going, if you ever were to, or not whenever you're eventually going
Not
to die.
if,
Everybody's
but
going to die,
when.
so
Yeah.
it's a matter of when, not if. um so yeah, those are still important, and we still recommend you work with an estate attorney to make sure that you have everything in place and set up properly. But yeah, so that's the proposed legislation. Some good information in there. I mean, I think for the most part, it's kind of what we expected. We expected them to really kind of extend everything
Hmm.
that the original Trump Tax Cuts and Jobs Act put in place, and then help out with the SALT deduction. A lot of people weren't very happy with the SALT deduction, and try to stimulate the economy through restoring 100% bonus depreciation, um,
Yeah.
and of course extending the estate tax, which Trump is a real big opponent on. Obviously, he's like a billionaire. He wants to.
Yeah. All rich people are, right? Rich
Yeah,
people
exactly.
hate the state tax for good
Right,
reason, right?
right, right.
Uh, and it's one of those things that the estate tax is one of those unique things that it really does affect rich people a lot, and their families and their legacy and all those things. But what people don't think about, so I come from, a farm and ranch community and family, and just large amounts of land, right? With the price of land, the price per acre going up pretty exponentially here in Texas over the last, 20, 30, 40 years. It's just difficult sometimes for people just to pass down land, and so it's a tough thing. It's a tough thing that people have to think about. And so it really is, really is a good thing to have, some appropriate limits on these things where, people can pass down a small business, an HVAC business or electrician business or things like a farm, and without having to mortgage the whole thing or sell off half of it to pay the taxes on it, that sort of thing.
Right.
So
Yeah. If you watched Yellowstone, you know all about that, right?
there you go.
That's like
Yeah,
the whole.
there you go. Don't give up an acre, right? That sort of
Yeah.
thing.
Yeah.
Uh, Yeah,
They were worried about
absolutely.
taxes the whole time, man. It's
Yeah.
the whole purpose of the whole show. They were worried about losing the ranch to the estate tax.
Yeah. Well, my wife definitely got tired of hearing me talk about how like nitpicking some of the things that they would say, how it's dramatized. Overall they're what they're saying is true, but there's some nuance there that they didn't get right to make the drama a little bit more intense. And
Absolutely.
my wife was definitely tired of hearing me talk about like, well, no, actually, pause the show, right? We have to get
Yeah.
this part right
Let me
because
draw
this is
this out. Let me diagram
yeah,
this for you.
exactly.
Yeah.
Exactly. We need to get the 10 key.
That's funny. I'm sure she'd love that.
Yeah. Yeah. Well, that's the bill, right? So
Bill.
I think we'll see what happens. We'll see what gets passed. We'll be here to update you guys on anything that comes up. We'll probably get the opportunity to read this bill a couple of times before it's actually passed, which is great. And but anytime there's a new big update, be sure and check in, and we're gonna have a post about it because it's important. It affects a lot of people's lives, and we don't get major tax legislation like this every year, so it'll be a meaningful planning opportunity for a lot of folks.
Right. Yeah. It's important. Like we said, it's all preliminary, but it does give you a good view into what they're thinking and kind of what they're planning for. I'm sure some things will change, but for the most part, I think this is probably what we're something very similar to this bill. This proposed bill is kind of what we're going to end up with. I wouldn't think that it'll veer too far from this proposed legislation.
Yeah, yeah. Well, if you have questions about this bill, you be sure and go to askacpa.co. That's askacpa.co. Drop a question there. You can drop a question even in the comments to the videos or podcast, wherever you're listening or watching here, and we'll be sure to answer them. And so keep an eye out. If you see some crazy TikTok video or something, you be sure and ask a question. We'll let you know if it's true or not for sure. But as we're keeping up with this, but subscribe, hit that like button, and ask your questions.
Yeah, absolutely. That's it's yeah. There's a lot of proposed changes, and things are going to be pretty fluid until the final bill. So yeah, certainly if you have any questions or need any assistance, feel free to reach out. And both of our contact information will be in the description down below. So yeah, if you need any help, feel free to reach out. We're both taking on new clients and yeah, helping small businesses and helping families make sure that you pay the least amount of tax allowable by law. And we both kind of have different types of clients that we work with, but feel free to reach out to either one of us. We're always happy to help.
Absolutely. Well, until next time, guys, we'll check back in with us later, and we'll have some updates. And next time, I think we've got a rapid fire question, teed up for the next episode. So be sure and check that out.
Yeah, that's gonna be really fun. So yeah, definitely check out the next episode and let us know if you have any questions. And yeah, we'll talk to you guys soon.
All right. See you later, buddy.
See ya. Thanks, Russell.